Okay, we're gonna end this part before we take a break and reception, talking about the lender of last resort, too big to fail, and financial systems savior. My favorite topics, and we have some really great people speaking today. Jeff Lacker, who is a former colleague and now a current colleague of mine at Mercatus, is going to be the presenter. And I've read his material, and I tell you, he's going to take us further down the trail of good intentions and moral hazard, the consequence of. So that'll be good. And then Amit will be next, and then Charlie Calomiris will be video. So take it away.
Great, thank you. Thank you, Tom. So to explain the scope of this paper, which I admit is a fairly lengthy one, I need to start with two definitions. Monetary policy actions change the quantity of central bank liabilities via buying or selling government securities. Credit policy involves acquiring private sector obligations, holding fixed the monetary liabilities of the central bank. That is, sterilizing the transaction via offsetting sales of government securities. Some transactions, some things the central bank do are a combination. Quantitative easing purchases of mortgage-backed securities, for example, or central bank credit programs that expand the balance sheet are combinations of monetary and credit policy. So my agenda today is first to survey the history of ideas, theories of the case, doctrines, for the want of a better word, about how the Fed should conduct credit policy. And along the way, I'll summarize the Shadow Open Market Committee commentary on credit policy. In the interest of time, I have to be selective, refer you to the paper for anything else you're interested in. So the Fed was founded to solve a monetary problem. When the public shifts from deposits to notes in a fractional reserve banking system, the money multiplier falls and the money stock shrinks unless there's an offsetting increase in high-powered money by the central bank. The Fed was founded to increase high-powered money in a panic or in response to seasonal shifts in the demand for currency. At the beginning of the Fed, lending was how the Fed was going to do this. So a combination of monetary and credit policy. The Fed founders were very aware of the British experience. The Bank of England had an effective monopoly on note issue, and the bank managed its monetary liabilities through its lending policy, as the Fed was expected to do at the beginning. The bank, purchasing government debt outright was politically sensitive for reasons that have to do with the Constitution of Britain, which contributed to Pat Keough's note that Britain was better at raising money than the French. So when Walter Bagehot and Henry Thornton, more importantly, before him in 1802, urged the Bank of England to lend in a crisis, it was to solve exactly this type of fractional reserve monetary problem, and to do it by increasing the supply of high-powered money. But it was not to address any credit market problem. It was to address a monetary problem. What they recommended became known in the 20th century as the lender of last resort role of the central bank. A better name, though, would be monetary instruments supplier of last resort. The crucial point is that the lending is unsterilized. Sterilized lending would be pointless in a monetary crisis. Thus, Fed lending doctrine number one, present at the founding, is that the Fed should lend in the pursuit of monetary stability if purchases of government securities are for some reason problematic, as they were for the authors of the Federal Reserve Act. In the interest of time, all I'll say about the real bills doctrine is that it was a fallacy. It was known in the 1920s to the smarter members of the leadership of the Federal Reserve to be a fallacy, but nonetheless, Fed leaders in the early 1930s misread signals because of the doctrine with disastrous consequences. The third founding lending doctrine of the Federal Reserve was Paul Warburg's mercantilist idea to try and move the business of financing U.S. foreign trade transactions from Europe to the United States. Doing so, he said, required that the U.S. have a central bank of its own to provide backstop support to the bills market to counteract foreign central bank support for their bills market. So this idea fizzled, and in the interest of time, I won't say anything more about it either. So the Great Contraction is a big topic. Time constraints require that I kind of skip this too. There's information in the paper about this debate about the role of bank failures and the Fed lending in that episode. But I have here this great quote from Friedman and Schwartz, in which they say that if the bank failures had occurred to precisely the same extent without the collapse in the money stock, they would have been notable but not crucial. If they had occurred, but a correspondingly sharp contraction in the money stock had occurred by some other means, it would have been a disaster. So that's Friedman and Schwartz's position. So the role of Fed lending changed significantly after the middle of the 20th century. After the 1951 Treasury Fed Accord, open market operations became the primary tool of monetary policy. Fed lending became a vestigial appendage, entirely unnecessary for the conduct of policy. Over time, the Fed moved to tightly targeting the federal funds rate, and Fed lending was routinely sterilized. Beginning in the 1960s, the Fed started getting requests from the FDIC or the OCC to lend to failing banks to allow those agencies to delay the closure of the failing banks. This facilitated the exit of short-term uninsured creditors, and it had the result of shifting losses to the FDIC or to other creditors. The Federal Reserve staff started calling these lender of last resort operations, but they really had nothing to do with Bagehot or Thornton or monetary stability, because they were, one, they were sterilized, and two, in these instances, depositors weren't fleeing to currency, they were fleeing to other banks with no implications for the money multiplier. As larger and larger precedents were set, the Fed was deliberately ambiguous about its likely future actions, seeking to preserve its discretion. Moral hazard grew in the form of an overall funding cost advantage for larger banks viewed as likely to be benefiting from this treatment, but perhaps as importantly, an advantage for short-term funding over longer-term funding. How big is the federal financial safety net? I asked two Richmond Fed economists to make that calculation for year-end 1999. They estimated that 27% of financial sector debt, total financial sector debt, the US, 27% was explicitly guaranteed at the end of 99, and another 18% was implicitly guaranteed based conservatively on past actions for similar institutions or announced policy. The total safety net went from 45% at the end of year-end 1999 to over 60% the next time it was estimated, which was for year-end 2009. So while these too big to fail precedents were expanding, the Shadow Open Market Committee naturally had some things to say. In the tumultuous year of 1974, following the bailout of Franklin National Bank, a key episode, Alan Meltzer, one of the co-founders, argued against preventing failures and for preventing the spread of distress through the monetary system, very much in line with what Thornton and Bagehot were talking about. Anna Schwartz, another co-founder, wrote extensively in the 1980s and 1990s, both for the SOMC and elsewhere, criticizing forbearance and how the Fed handled crises. She distinguished between what she called real financial crises, by which she meant the scramble for high-powered money in response to shifts out of deposits and into currency or hoarding of reserves, and other episodes which she called pseudo-crises. And she asserted that no real financial crises have occurred in the United States since 1933. And she noted the moral hazard effects. I love this sentence: "The bugaboo of financial crisis has been created to divert attention from the true remedies that the present financial situation demand." Classic Anna. So Anna Schwartz gave the Homer Jones lecture. We heard about Homer Jones earlier today. at the St. Louis Fed in 1992, and she titled her lecture, "The Misuse of the Fed's Discount Window." In it, she noted how Fed lending since the 1960s represented a major departure from its traditional approach. And she called for closing the discount window and restricting the Fed to open market operations in U.S. Treasury securities. Again, this is consistent with Bagehot and Thornton and her and Milton Friedman's diagnosis of the Great Contraction. Marvin Goodfriend, my former colleague at the Richmond Fed, joined the shadow in 2009. But even before then, he wrote extensively on Fed credit policy. He pointed out that credit policy is extraneous to monetary policy and inherently distributional. He made this point in a paper with Bob King in 1988. This point was also made by Milton Friedman in his book, A Program for Monetary Stability, 1960, I think it was. It amounts to selling Treasury securities and lending the proceeds to the private sector. Because it channels credit at favorable terms generally, it will inevitably entangle the Fed in distributive politics, which risks the critical independence of monetary policy. Goodfriend advocated for what he called a credit accord, analogous to the 1951 Treasury Fed Accord on monetary policy. Under his proposed accord, the Fed would limit its balance sheet to holding Treasury securities and would leave credit allocation to the Treasury to be carried out with duly appropriated funding. A little bit of information here about an announcement, a so-called credit accord announced in 2009. It's sort of a fig leaf, so I won't spend more time on it. Fed lending in connection with too big to fail rescues represented a departure from the three founding Fed lending doctrines that I mentioned earlier. So how are we to understand the late 20th century Fed credit policy? Marvin Goodfriend and I studied this question in a paper we prepared for a 1998 conference at the Bank of Japan. Central bank lending is analogous to private line of credit lending, we observed. Line of credit lending involves a commitment problem. Private line of credit contracts presumably structure ex post incentives for a profit maximizing lender constrained by their contract to lend in the circumstances that are, from an ex ante point of view, optimal, and not lend accordingly when it's optimal. The central bank's ex post incentives are not necessarily those of a profit-making, maximizing lender, however. So there's no guarantee that a central bank choices about lending are going to be optimal ex ante. There's a desire to avoid deadweight resolution or closure costs, even if that would be part of an ex ante optimal arrangement, which we know can be true. There's a fear of political blame if financial turbulence results from not lending. On the other hand, there's a fear of criticism for overreach, for lending too far afield. This is a situation that James Buchanan described as the Samaritan's dilemma. What you want them to believe ex ante is not what you're going to end up doing ex post necessarily. Thus, we get constructive ambiguity, a communication strategy that attempts to discourage expectations of rescue while preserving the option to rescue an event. And the general result is a cycle. Financial distress occurs at a failing institution. Short-term creditors are rescued, setting a precedent that expands the implicit safety net. Regulators and/or legislators crack down on the specific risk-taking that was the proximate cause of the crisis, which heightens the incentive to bypass the regulated sector, pushing risk-taking into the so-called shadow banking world. The fringe of the implied safety net is where the next crisis hits, and the safety net continues to ratchet and expand outward. The system grows more fragile over time as interventions continue across an expanding domain. So from this perspective, I think we can extract an implied lending doctrine number 4, which I call the reluctant Samaritan. Fed lending decisions are made case by case at its discretion to mitigate ex post resolution costs, help the FDIC or someone else to avoid closure, failing banks, to avoid the political fallout from financial market turmoil that might arise if lending is withheld, but also to minimize the perceived expansion of the safety net and perceived departure from past precedent. Communication tries to minimize expectations of future intervention, but preserve maximum discretion. So there we were at the end of the 20th century. Entering the 21st century, as the great financial crisis played out, there was some continuity with 20th century lending doctrines. At the very onset of the crisis, on August 9th, 2007, monetary stability was in play. A sudden sharp rise in perceived counterparty credit risk in the banking system led to an increase in the demand for reserve account balances, exactly the type of hoarding that Thornton and Badgett described, and that had the potential to reduce the money multiplier. To maintain the federal funds rate near its target, the New York Fed's trading desk needed to add a huge amount of excess reserves, which they did via open market lending operations, precisely the response that a classical lender of last resort doctrine prescribed. But note that it was automatic under interest rate targeting regime and did not require any sort of intervention into credit markets per se. More broadly, though, monetary stability in the sense of Thornton and Badgett were never a serious problem during the great financial crisis. There were no flights from deposits to currency to speak of, and no scramble for reserves or high-powered money that the desk could not easily meet. Then at the zero lower bound, the demand for high-powered money was satiated. So the reluctant Samaritan doctrine seemed operative as well in the great financial crisis. And I'll just touch on a couple of things. Interventions, such as in the Bear Stearns case, restored calm to financial markets simply by raising expectations of future interventions in similar cases. In other words, the Fed intervention prevented the contagious spread of the expectation that the Fed might not intervene to rescue investors in other similar firms. At the same time, the Fed's response in the great financial crisis went well beyond 20th century doctrine. Starting on August 16th, 2007, near the very beginning, the Fed undertook a prominent and aggressive campaign to encourage banks to borrow at the discount window. The Fed cut the discount rate from 100 basis points over the federal funds rate to just 50. The next morning, the Clearinghouse, an organization of the largest banks in the country, convened a call for its members, on which then Board Vice Chair Don Cohen and then Federal Reserve Bank of New York President Tim Geithner urged banks to view the discount window as open and available and free from stigma. Tim Geithner organized a coordinated and publicly announced demonstration the next week in which the top 4 U.S. banks borrowed billions from the discount window. The effort to boost discount window borrowing ultimately failed, however. Discount window lending rose from about 200 million before August to a peak of 7 billion in September, then declined. Borrowings at the federal home loan banks increased by $237 billion in the second half of 2007. This highly visible Fed effort to promote borrowing must have had serious incentive effects. Capital markets were open for the large banks over the next 12 months, and they could have raised more equity than they did. Notable example, Lehman Brothers. In April 2008, they go out with an equity offering. They received subscriptions for $30 billion. They took 5. They could have raised more money, but weren't willing to incur the dilution costs to make themselves less vulnerable. In short, banks did not seem to be net worth constrained in 2008. On the funding side, large borrowers could have easily reduced reliance on overnight repo borrowing, though it may have been costly. This campaign to promote Fed lending was far different than the Fed's 20th century approach, where the Fed seemed somewhat defensive about its intervention, somewhat chagrined, and the discrete credit programs that came later were also far out of scale with what happened in the 20th century. Lending doctrine for the 21st century. So what we saw in the great financial crisis, the extent to which it represented a break from what happened in the 20th century, suggests that the Fed is now operating under some new lending doctrine. What might that be? The board's website provides some clues. I've reproduced here some verbiage that can be found under the tab Financial Stability. They talk about a financial stability mandate, to promote financial stability, how in a crisis financial markets may effectively cease to function, and the Fed is empowered to intervene in credit markets to restore the normal flow of credit. So this articulation that you find there in the supporting documentation and subpages leaves us with some unanswered questions, among them the operational meaning of the undefined terms in bold, but also how credit markets ought to function when uncertainty about economic fundamentals becomes significantly elevated. What is normal when the real economy is in distress? That's the question. So digging down underneath the board's website language, you can discern, I think, the influence of economic ideas. A large literature in economics emerged in the 1970s, or starting in the 1970s or so, exploring economic models with limited information, adverse selection, moral hazard, and the like. The best of these were very clear about the economic fundamentals of preferences, endowments, and technologies. Information problems, just like technological constraints, limit attainable outcomes. When applied to financial arrangements, such models are capable of displaying as endogenous outcomes recognizable financial contracts like debt and recognizable multilateral arrangements like banks. These models have significantly advanced our understanding of financial arrangements. Some of these models provide examples, and I'll call them possibility propositions, in which, under certain circumstances, central bank lending can improve outcomes. But the case for central bank lending in these models is typically quite sensitive to key assumptions. In many settings in which the Fed intervened in the great financial crisis, the match between possibility propositions and reality was not at all obvious. I'll mention just a few. The celebrated Diamond-Dybvig example of a Pareto inferior run equilibrium is sensitive to depositors being isolated from each other and from the bank, and to the form that investor contracts are allowed to take. And it's not clear that those restrictions are a good match for modern markets. Cash in the market pricing depends on market segmentation and banks' lack of access to funding. But in August 2007 and beyond, there were widespread reports of money on the sidelines waiting for more advantageous pricing. Adverse selection models are notoriously delicate. And then there's the credit channel, which starts from the premise that limited information implies that contracting frictions, that implies that credit extension is costly. All well and good. I totally buy onto that. Ben Bernanke and Mark Gertler in the late 1980s took this observation further and argued that in times of financial crisis, investment might collapse. The laissez-faire, no intervention allocations in their model are Pareto optimal, however. So their argument essentially is that transferring net worth to banks via subsidized central bank lending can be a worthwhile trade-off for society. Evidently, this is at least an empirical question. So here isn't the place to hash out the merits of these possibility propositions. I just want to point out that during the great financial crisis, there was no staff work that I'm aware of, and virtually no policymaker discussion of the applicability of these various propositions. No work comparing model frictions to observations, no quantitative assessment of redistributive interventions, just no real interest in the economic foundations of the credit market interventions that were being considered. Moreover, to the extent that financial markets might have seemed to the casual observer as excessively fragile, there was no effort made to assess whether that financial fragility was inherent in laissez-faire financial markets or induced by 40 years of bailouts. Staff analysis seemed to start with a broad premise of inherent fragility and proceed directly to program design, which is what occupied the vast bulk of their time and effort. The influence of ideas then, of this economics literature that's been so productive, was to license a general presumption in favor of interventionism. So I think this general presumption played a significant role in Fed credit policy and its break from 20th century practice. Second candidate for the 21st century shift in credit doctrine is politics. So the distributional nature of Fed credit policy places the Federal Reserve at the very center of this fraught and fluid relationship between banks and the state, the history of which Charles Calomiris and Stephen Haber so vividly described in their 2015 book, Fragile by Design. Early 20th century credit policy owed much to politics, such as that expressed in Warburg's mercantilism, as it did to theoretical ideas such as Thornton's monetary theory. The evolution of Fed credit policy in the second half of the 20th century was also a byproduct of political environment and governance. Having an independent balance sheet with which the Fed, after the accord, could intervene without monetary policy consequence left the Fed exposed, in possession of a vestigial tool of keen interest to the banking industry, but subject to a serious time consistency problem. The reluctant Samaritan fed and was fed by the growth of large banks, but might have struggled by itself to meet the challenge of subprime losses in 2007, given the induced fragility of the system. The influence of politics and inherent fragility perspective seem to have been complementary. The credit view emerged alongside of and rationalized the growing interventionism of central banks. In 2007, the credit view's commitment to interventionism dovetailed with the self-interest of Wall Street, whether intentionally or not, and exacerbated moral hazard. The resulting turbulence provoked a fierce populist backlash, but for now, inherent fragility seems to be the prevailing view. We have, therefore, what I describe as the sell-side savior. Sell-side because intervention favors those selling IOUs of some sort. The Federal Reserve intervenes in any credit market at its discretion to restore the normal flow of credit to borrowers when financial markets experience distress. Interventions are designed to be seen as fair. Interventions are chosen ex post, and the domain is broad. Any debt market is in scope. Political support for intervention is broad as well, so the risk of blowback for overreach is small. The reluctance of the late 20th century has receded. The political constraint now simply is that interventions are seen as fair. So this is where I believe we find ourselves. My hope is that in the years ahead, the Shadow Open Market Committee can contribute to a constructive evolution of Fed lending doctrine. Thank you.
Thank you to the organizers for inviting me. It's a real honor to discuss this paper. The paper is very rich, as you all saw from the presentation. I learned a lot from it. It masterfully tells you about the progression of Fed's role in monetary and credit policy. I have limited time, as you know, and I know that everybody's tired. And so I won't be able to do justice discussing everything in the paper, but I highly recommend everybody to read it. What I will do is I will focus my remarks on one aspect that connects a lot of the themes in the paper. That theme is going to be about governance and how it's intertwined with credibility for independence that Fed has. There's nothing to disagree really in the paper from my perspective. I'm actually very happy that I'm going after Charlie. It's hard to outdo Charlie Calomiris. For those who know, you'll see it, what I mean. Even though he's going to be online, it's going to be hard. So the way I want to sort of structure this discussion is to talk about the healthy tussle between public interest view and the private economic interest view of regulation. This tension is articulated by this famous quote by Stigler, not invoked, Milton Friedman many times, obviously. But Stigler just is a good reminder that we have to be mindful of the fine line one has to draw when regulating the industry. And this is particularly salient for banking and Fed, partly based on how the governance for the Fed is set up. What do I mean? So if you look at how the governance of Fed is set up, it has different classes of board of directors. Some come from the industry, some public at large, and some from the Fed. Now, of course, a structure like this, it's pretty unique. It could have many benefits. But the structure is also particularly susceptible to interests of the industry. And this was articulated many times, including by GAO, for example. This is a quote from 2011. And concerns like these are amplified when you also look at the heavy movement of personnel between the Fed and the private sector. So here is a plot that some of the analysis that I have done, where if you look at all the Feds and what's the flow of employees who work in the Fed to the private sector, financial, non-financial, and otherwise, and you see a pretty substantial number there. There's nothing wrong with that per se. This allows for a vibrant talent pool that gets attracted in the Fed to begin with. But the fact is that the structure that I showed you before and these patterns tell you that like the governance needs to be extra careful about maintaining credibility with respect to independence from the industry. And this applies both for monetary policy and for financial stability. If you had taken any class on corporate governance, and I do teach corporate governance, the general governance principle in such a setting would tell you that you got to establish a pretty strong credibility for being independent. And where will that come from? Well, they'll come from various themes that have been articulated for 50 years, probably, by this forum. And also, we've heard many, many speakers talk about. So it comes from, obviously, the commitment. So emphasizing rules rather than discretion. We saw that starting from John Taylor's talk yesterday. It comes from establishing reputation. Reputation for what? Willingness to take tough decisions. And it comes from transparency. And we saw a bunch of these themes in the previous panel. Charlie and Debbie both talked about this. So this obviously connects with all of those things. So in my discussion, what I want to do is to argue that this credibility on independence is dented. And it's dented in a pretty substantial way. I think there is now a lack of commitment because there is simply too much discretion in the system right now. What that means is that there is an interaction with potentially reputation. Why? Because discretion leads to automatically finding ways to not take tough decisions, which means you lose your reputation. Now, Fed has been a fantastic institution. Reputation building takes time, but reputation can be destroyed very, very quickly by such decisions. So let me elaborate what I have in mind based on some of the research I've done with my collaborators. So why do I say that there's more discretion potentially in the system? Now, we've had a bunch of failures. Jeff sort of talked about the whole history. And whenever there is failures, we think about rules. And what rules? Well, we are going to regulate the banks. We are going to supervise them. And here is a list of the rules. We are great at addition. We are not great at subtraction. We know that. But a lot of these rules, especially spiking after the financial crisis, are all about supervision. You know, what can banks do? What can they not do? And like, we are going to figure them out. And are they safe or not? So you would think that with so many rules, there is not much room for discretion. And let me give you an example on how much discretion there really is. And this is based on a pillar of financial stability. And one of the pillars of financial stability is trying to figure out the CAMELS rating. What does CAMELS do on a bunch of dimensions? Capital, asset quality, management quality, earnings quality, liquidity quality, sensitivity to risk. We are going to rank banks from 1 to 5. 1 is good, 5 is bad. And with so many rules, we've kind of minimized the discretion. At least that's the hope. Now you can see that some of these components will have more discretion than others, for example, management quality. Now, what do we do with these ratings? We add them up, we construct a composite, and again, a composite score gives you a rating from 1 to 5, 1 good, 5 bad. And all the policy decisions are then pegged to this, from deposit insurance to whether banks are allowed to expand and so on. And so is there a lot of discretion? Well, we sort of looked at the data to tell us that. So we looked at Camel's ratings and asked how much of the variation in the composite ratings are getting driven by different components, because you could argue that some components are more discretionary, others are not. And what did we find? 50% of Camel's rating is driven by management quality. That is a lot of discretion, I would argue. Now, you could say that, well, there's a lot of discretion, but how do we know it matters? Turns out when there is fragmented responsibilities, overlapping jurisdictions, same rules can be interpreted very, very differently. Here is one way to see this. A vast majority of banks in the US financial system, actually I'm keeping track of time just to make sure, self-governance. All right. Turns out that when responsibilities are fragmented across many regulators, you could have a lot of discretion playing a role. So a bunch of banks in the US are supervised in rotation between state regulators and federal regulators. So same bank looked at by state, then by Fed, by state, and so on. The advantage is you can look at what are the Camel's rating given to the same bank by two regulators virtually at the same time. And I'm going to show you that figure. The white bars are going to be when states are looking at the bank. The dark bars are when the Fed are looking at the same bank and giving it a Camel's rating. Remember, higher Camel score on the y-axis, tougher rating. So here is how it looks like. When the states come in, the white vertical lines, they lower the Camel's rating. When the Feds look at the same bank, the dark vertical bars, they raise the Camel's rating. When the states come, they lower the rating. You get the idea. Especially when the states are and the local economy is not doing very well. You would argue that this is a lot of discretion in the system. Now, that was just two regulators. Just to remind you, we have a system now of these many regulators. I know that John Cochrane likes this figure because that makes his plea on the fiscal theory of price level very clear to at least one of the regulators. When you have so many regulators in the system, it's hard to argue that there is not going to be discretion multiplied. That means many voices, uncertainty for banks, and certainly not a clear firm's rule-based approach. Now, discretion has also meant that we have not taken tough decisions, in my view. We saw that in terms of monetary policy. Lots of people talked about monetary policy was too loose for too long. Financial stability is similar. We saw it in the turmoil last year. Here is one way to see it. If you look at the fundamental issue in the financial sector, what is the issue? The issue is this. On the x-axis is different size of banks. On the y-axis is how much leverage, how much debt they have. You can see that. I don't know how to explain this, but all the leverage is the same and it's 90%. It's pretty high. What that tells you is that small decline in asset values, whether they come from credit risk in 2007 or interest rate risk like last year, will threaten insolvency. Now, one simple, tough way to think about this is that, well, the way you sort of solve for shocks is you create more buffers, have more equity in the system. But then banks start complaining. What is the complaint? Equity is expensive. We can't run the business. And that has been the general complaint. But we now can see that there are many other institutions out there who, non-depository institutions, who are doing the same kind of activity. These are called shadow banks, non-banks, whatever you might want to call them. Now, some people are calling them private credit. Here is an example of one such industry. So this is the $12 trillion mortgage industry. And if you look at the leverage debt levels of non-banks, doing the same activity as banks, this is what the picture looks like. What is this picture telling you? That they have a lower debt, which means more equity than banks. Especially the gap is highest for middle and small banks. What that tells you is that small and medium banks have a lot of leverage. They could do it at much lower leverage. That means they are eating subsidies and over-levered. This issue has been all around, all the turmoil and the banking crisis. A tougher rule-based approach would tell you we need to identify an insolvent bank, we need to restructure, we need to raise equity. Why do I say that discretion has crept in? Because the discretionary approach is the easy approach, I feel. Why? Because now we can reinterpret solvency, which is hard to sort of pin down, but we can call it liquidity. And once we call it liquidity, we are in this Heisenberg's principle applied to physics, but this is in liquidity world. And I like to call it Heisenberg's paradox. Why? Because we can neither define nor measure this. Liquidity is sometimes slow, sometimes fast, sometimes sudden, could be multicolored. You get the point. But all that does, as Jeff has pointed out, is if we rely on liquidity, we can immediately go to lender of last resort and infest the whole system with subsidies, because we are clearly not looking at what costs it is potentially putting us through. I will not repeat this chart because Debbie talked about it, and then it was talked about in other panels as well. But you can look at the size of the interventions out there. When it's a liquidity problem, seems like there are only benefits. There are no costs. But we don't know if all of these events were actually liquidity events. Maybe they were, maybe they weren't. And if you look at the size of the intervention, they kept going up. And this, I again argue, is probably because discretion is endogenously leading to a mission creep, which also we have spoken about. By the way, because Fed is such an elite institution and something that everybody looks and aspires to, this has spread everywhere. That's a separate cost that one has to think about. If you look at who is right now doing the discount window lending, there is this entity called FHLB that some of you might have heard about. They are doing a lot of discount window lending. They did it in COVID, they did it in the Great Financial Crisis. And why are they doing it? Well, they were supposed to stabilize house prices, but I do not know if that's what they are after anymore. All of this is to say that the credibility is a question. And I will sort of give you 3 examples and then wrap up to show you what I mean by the credibility being dented. So let's first talk about the recent financial turmoil with failures of SVB, First Republic, Republic First. Actually, Republic First is a bank that failed. What was the diagnosis of the Fed? Surprise, surprise, liquidity. The Fed report mentions liquidity 300 times, and insolvency was mentioned once, which I always joke was a typo. It has been quickly adopted by other regulators. And while this is all great, and liquidity was diagnosed, and we injected the system with more liquidity, which should be short-term, mind you, over months, banks kept failing despite the liquidity infusion. And the reason was SVB and other banks were insolvent. They took interest rate risks. They didn't hedge it. Their values fell. The values will be there. They are not. This is not a liquidity event. This is a capital issue. This is a reorg issue, but we don't want to take tough decisions. And that's fine, but this is not the worst part. The worst part, which gets at the credibility, is simultaneously there was this Basel III endgame discussion going on, which Fed was also part of. And part of the discussion there was, hey, banks should raise capital. Why? Because many things, but also look at the turmoil last year. But remember, Fed's report itself always said it was liquidity. So how long do you think it took industry to latch on to it to say, hey, the turmoil had nothing to do with capital. We don't think this is a capital issue at all. And lo and behold, the Fed then comes back and says, well, we can't push this through. That raises the question, who is Fed playing for? A lot of people have raised this issue. This is not my issue. Similarly, there is a big debate about innovation in the financial sector. Whether it's fintech, whether it's payments, whether it's crypto, whether it's private credit right now, it suffices to say that US is behind the curve in a lot of this innovation. It's not because innovation is not happening in the US, it's not being brought into the financial sector. And why is it slow? Well, one narrative is that the banking sector argues that this is really bad for their profits. No surprise. Yes, that's what competition does. It also forces incumbents to innovate. Here is banks complaining about CBDC. What's the complaint? Deposits will go. We will lose our profits. And lo and behold, Fed comes back and says, well, this is not even something that we are taking seriously, which is all fine. But then the question is, again, about governance and credibility of independence. The last example I will just mention very briefly is the one which many of you have already brought up, which is about the unwinding of what has been wound up in the Fed balance sheet. Here is another picture, one last time. We have seen this picture. The Fed balance sheet is huge. We did this, and the whole notion was around this time we are going to unwind, but I don't see much of unwinding at that time. And why did that happen? Because there was a lot of pushback from the industry, from other places that, well, this would be bad for us and so on. So we just let go. And every time Fed lets go, credibility is an issue. So let me conclude. I think this is a great paper. Everybody should read it. I learned a lot about it. My main theme here was to talk about governance. I argued that governance in the case of Fed faces a little bit more headwinds than otherwise just because of the unusual structure. The unusual structure has clearly some benefits, but there are also costs. And to be effective, you've got to establish some reputation. Right now, there is too much discretion that blunts the will to act tough. There is a propensity to reinterpret events that leads to infestation of lender of last resort. I also should note that if you have too much discretion, there is no metric to evaluate the performance of the Fed either. Some of you have already brought that up. What do I have in mind there? That if it's heads, I win. I save the system from sudden shocks because shocks are always sudden. And tails also I win because if there's turmoil, see heads. Shocks are sudden and I save you. If you think this is just something that I'm making up, you should just read the press right now and see what investors are saying. Here is a quote from an investor in the press last week. Investors have comprehended that they'll make money in good times and bad. This is investing in bank stocks. That should tell you a lot about what the industry feels. So I feel that governance tells you that if your credibility is dented, you need to reorg or reset. This is a great institution, and we should not lose it by not resetting or reorging. And that would be my plea. Thank you.
Thank you. Thank you very much. Now, I think we're going to have Charlie join us.
Thanks for your tolerance. As you can hear, I had got a sudden cold or whatever it is, and so I couldn't be there. And I hope I don't lose my voice. I don't think I will. First of all, let me compliment Jeff. This was a remarkably comprehensive review of the issues and the specific positions that SOMC members and the committee as a whole have taken on this controversial and difficult area. And I think he did the SOMC a great service by going back through all this material. And it's impossible to do justice to what he did as a discussant. And he laid out the various points of view, I think, very well. And of course, I love all that Amit said. I very much share both of their concerns about excessive bailouts. And in my own research, this undisciplined and politicized bailout process that is not, I think, sometimes, in many cases, not justifiable on the basis of economics, and is certainly much worse because it has so much discretion built up in it. Seems to be, I think, a major concern, and I think Jeff shows it's been a major concern of the SOMC, and that's something that all of the SOMC members who've worked on this have in common. I think it's important to say that. When you ask about the solution to it, that's where you see a dividing line in some of the writings of the group. In fact, Jeff himself mentioned in his comments that Friedman and Schwartz said, well, we don't care if the whole banking system disappears. If all the lending of the banking system disappeared and all they did was produce deposits, that would be fine. So in fact, I guess that means 100% reserve requirement on banks would be fine. And from a cyclical standpoint, the disappearance of all bank credit wouldn't be an issue from their point of view. Of course, Jeff also noted that in the 1970s and the 1980s, a different point of view about bank lending, that they saw it as a major kind of important state variable in the economy, that not just the supply of money, but the supply of bank credit was very important because it didn't have good substitutes in the financial markets and even across the banks themselves, so that in certain locations, if bank credit dried up, the fact that some other state had a surplus of bank credit wouldn't be enough to create a normal functioning economy in the place where the bank credit disappeared. So the thing that happened in that 1970s and 1980s was a view that bank credit supply in the local area of the economy was very important. And that, in a sense, even if the money supply, which is an integrated aggregate, even if that's behaving fine, local credit supply matters still. The reason I'm emphasizing this, which Jeff also mentioned, is because, as I'll show, this is a very important thing to bear in mind, because it would be, of course, much easier for us if that weren't true. And within the SOMC, Jeff mentioned Anna Schwartz's Homer Jones lecture, and also a paper by Goodfriend and King back in the 80s. But what those papers did was they said, well, with a properly functioning Fed funds market, banks can distribute, we can prevent the money multiplier from collapsing. Banks can provide credit reserves to each other. And so we really don't need anything but open market operations to preserve financial stability and macroeconomic stability. I don't agree with that view. And I'll also, although I don't want to say too much about Alan Meltzer's points of view on this, because he's not here to defend himself. But of course, Alan, I think, especially in the last paper that he wrote, which he was a co-author of mine, took a different view. And that different view, I think, is that we do care about bank credit. And unfortunately, because we care about bank credit, we still need some of these mechanisms. And that's where the difficulty is. And the way Alan always used to put it, whenever he would testify about the lender of last resort, was the Federal Reserve has never articulated the rule that should guide the lender of last resort. And I would generalize that to, and the government in its implementation of TARP and the creation of those has not articulated the general rule that should govern that either. And I, in a paper I wrote with Luke Lavin and Mark Flandreau, we tried to come to some sort of beginning of articulating what a rule-based approach would look like for that. So I want to emphasize, I think that this is the interesting thing about the shadow committee, is that it's always been very skeptical of the actual policies and seen them properly and correctly as politicized and often ineffective and wrong-headed and counterproductive. And yet there are two groups within the writings of the shadow committee members, one that says, let's just get rid of them, and another that says, well, we can't get rid of them because there's this little problem called bank credit matters. And so if local bank credit matters, we do have to take interventions that worry about bank credit more seriously. And so I think that's the interesting kind of intellectual differentiation, despite all the commonalities. And I think that fits very well with Jeff's overview. Next slide, please. So I've already talked about most of this. I also just want to, in passing, also say that, you know, Jeff, when you talk about Thornton and Badgett, you know, they use the word money a little differently from the way we do, because they were talking about bills of exchange and domestic bills. Most of the market that they were looking at, which they called money, was actually a credit instrument that also served as a monetary instrument. So when they say money, and more generally, when people used the word money in the 19th century, they didn't mean M2. They meant money market instrument. And I think that, you know, it's a little hard to say that they backed the narrow view of, let's say, that Anna took in her Homer Jones lecture. I don't think they did. So what I want to do, next slide, please, is talk a little bit about what I think the implications of these, and then just give you a little bit of a taste for why I think we're stuck with the more difficult view, which is we have to try to formulate a rule to guide our interventions. We can't just dispense with them. So the first thing I'm going to talk about empirical work that shows why three kinds of things are true. One, a negative shock to banks' net worth can't be sort of immediately undone with a monetary expansion. And I'm going to use the example of New York City in the 1930s in just a minute. A second point is a sudden shock to borrowers' pre-existing supply of credit that they were getting, let's say, through the commercial paper market, was properly and best dealt with by the Fed. This is, I think, a big success of the Fed, the Penn Central crisis of 1970, using lender of last resort rather than trying to solve the problem with expansionary open market operations. Basically, lender of last resort was a well-articulated smart bomb that dealt with a temporary credit problem fairly well. And a third implication of this is that because of asymmetric information, when shocks hit and people can see that there's been a big shock, but they don't know the incidence of the shock, then they start seeing one bank in trouble, and they can think rationally, in fact, that other banks may be implicated. And it's that kind of asymmetric information that sort of informs lender of last resort policy. And again, generally, the open market operations are not going to be a solution to this kind of information problem. They don't stop, let's say, withdrawals from banks that based on depositor fears. They can't really. Open market operations just can't solve that problem. That's why you need, depending on how severe the problem is, you need either traditional central bank discount window lending, or lifeboats, or TARPs, or something else. And that's comparing those and trying to understand why they're differently useful in different periods was the subject of this paper that I wrote with Flandre and Levin. So those are the 3 points I'm trying to make, that I think we have a lot of evidence that tells us we can't just dispense with the lender of last resort and rely on open market operations. It just doesn't work very well to solve a lot of real world problems that we understand are well grounded as problems in economic theory. Next slide. Just to give you a sense of New York City banks. Now, by the way, none of these banks failed. This is an average of the banking system in New York City. None of them failed during this period. But you can see that the ratio of loans to cash plus treasuries went from, at the January 1929, it was over 3. And by January 1940, it was 0.3. And what's happening there is there's a huge contraction of the banking system because the banks suffered real losses. And as part of restoring the confidence, that column marked P is telling you what the implied default risk in basis points of deposits in New York City banks were. So you can see they restored that confidence over time, but to do so, they had to basically become much less risky on their asset side, which is why they got rid of all their supply of lending practically. And the point is, in these situations, bank credit contracts sometimes dramatically. In a paper that Joe Mason and I wrote, that's in the AER in 2003, we developed a kind of instrumental variables approach to try to measure how big the local, that is state-specific, contraction of credit was, and then how the exogenous contraction of bank credit locally affected state income. Next slide. And so just to give you the bottom line answer here, it looks like the elasticity of state income with respect to the local contraction of bank credit was about 0.4 to 0.5. In other words, putting aside the aggregate effects having to do with the money supply, which were common across the whole country. If your state had a 5% contraction of credit supply, that meant roughly a 2.5% contraction of state income, and that's putting aside the aggregate effects that you might attribute, let's say, to the money supply. Coming to Penn Central, the point here was we had an evolution of a new kind of market in the US in the 1960s, the commercial paper market, which was nothing like the traditional commercial paper market. Again, language can be very deceptive. This was a very different market. It was not a banker's bills market. It was a new kind of credit market, and the holders were corporations and other institutional investors, but it was nothing like that traditional market. This was a fairly new market. It appealed to extremely creditworthy firms that had access to the bond market, and that all of this CP is basically rated at a very, very low tolerance for risk. As soon as you got any risk, you were rationed out of this market. This was only, not just investment grade, but only sort of AA rated short-term. And Penn Central was a commercial paper issuer. They went into default, and this was a major shock to the market. In fact, it completely restructured the market for commercial papers. People realized that their ways of thinking about risk were wrong. And suddenly, this very large amount of commercial paper is not going to be rolled over. All these borrowers had migrated out of their banking relationships into the commercial paper market because they were so low in risk, and all of a sudden they needed money like crazy. So the Fed said, there's a big gap between the Fed funds rate and the discount rate, which was interpreted, of course, as a non-pecuniary penalty on the margin for accessing the discount window. So the Fed basically said, if what you're doing is accessing the discount window to pass it through to commercial paper that's rolling over, we won't penalize you we at all. And this was a very effective way to create a pass-through. And note especially, people didn't know how long it was going to take for the commercial paper market to be restored. And so it was really nice.
We got to finish up.
Oh, okay.
Sorry, you're out of time. Keep going, but just
Oh,
wrap
how
up.
much? Okay, will do. So the point is, this worked very well. And if you had tried to do it with open market operations, I don't think it would have worked very well. It would have been okay. You could have done something, but it wouldn't have been this kind of smart bomb that it needed. Another thing on bailouts, just in Canada twice, in 1906 and 1908, the Bank of Montreal decided to orchestrate a lifeboat to let these failing banks be acquired by the aggregate of all the surviving Canadian banks. They generally didn't organize lifeboats. They let banks go. But in these cases, they acquired these banks as they were failing. And so what it shows is that this is not just a government intervention or a political sort of move, but that sometimes private entities can decide to bail out banks, to acquire them, to prevent, and I've discussed with Steve Haber, we discussed these examples more, to prevent a kind of systemic risk that comes from the fact that there's asymmetric information in the credit market. Next slide. I'll skip right to the conclusions.
Okay.
Stay with this slide for a minute. This is the last substantive one,
Okay.
because what it's basically talking about is why you need HARP or RFC in the 1930s. And the reason you need that is because sometimes lending to banks that are insolvent or even near insolvent, or even just very risky, isn't good enough, because it actually takes their collateral away from them, because the Fed gets the collateral first claim on the collateral, actually makes the banks more prone to runs. And everyone understood this in the 30s, and that's why we created these kinds of assistance for banks. And in the next couple slides, just flip through them. One next. Okay, so this one, those two slides are showing you that banks that received, for exogenous reasons unrelated to their risk, received earlier preferred stock assistance by the government, not only had better survival histories, but also were able to maintain their loan growth better than other banks. Now on to the conclusion. So really, I've just tried to show you that I think that we're stuck with the difficult problem of having to actually have a systematic policy for lender of last resort, which includes the Fed, but actually includes the Treasury too. And that I don't think that we're there at all. And I think this is the same message really Amit and Jeff would agree with, which is this really needs to be the thing that we focus on. And I'll stop there.
Thank you very much, Charlie. Thank you. We have a couple minutes. Well, we'll make a couple minutes, put it that way, for say 3 questions, and then we'll let.
Thank you. Amazing presentations. I don't want to derail the conversation away from the main topic, but I think that looking forward, one risk is that the next big crisis might be a debt crisis, a treasury type of run on treasuries. So if that investors smell that risk and we start having wobbles in the treasury markets, I guess the Fed will come in and intervene under the guise of some market functioning issue. So how do you think about that part of the financial stability mandate of the Fed? What are the rules of the road? It seems to be a very fuzzy area where repeated interventions there might actually induce significant moral hazard.
Hi, I'm Jack Krapansky. Real simple question on Silicon Valley Bank. Before that happened, I thought bank runs were just a thing of the past, the 1930s or something. How frequently do you think actual bank runs will be in the future? And isn't there some way, I mean, Silicon Valley had assets, so couldn't the Fed have taken the assets but kept the depositors whole so that we don't have this banking integrity? I don't want to protect the bank, but I want to protect banking integrity so people don't have to feel like they have to run.
Good. Okay, we'll let Jeff reply and then
First,
Charlie.
thank you to, is this on? Thank you
Yeah.
to Charlie Calomiris and Amit Seru. I really appreciated your comments. Charlie, we have a lot to talk about offline sometime, but I appreciate your generous spirit. The Fed does intervene at times in the Treasury market, saying they have concerns about market functioning. At a certain level, I know what they're talking about. At a certain level, I don't. Like at the level of a model with preferences, endowments, and technologies spelled out, I'm not quite sure I get it. And again, it goes back to this question of, how should markets behave when, how should financial markets behave when the real economy is really uncertain? About runs, there's a good paper by Jonathan Rose, 2015, a working paper at the Board of Governors that documents the runs in the Great Financial Crisis. He shows they were all runs from one bank to another. So the runs like we had in the Great Depression, where people took their money out and took currency home with them, those are a thing of the past, but runs are a real thing. And they're less about people showing up in line than they are about large depositors that have access to a bunch of different banks to just move their money to another bank. But thank you for those questions.
Amit?
Yeah,
Go ahead.
I'll just say one thing, which is people focus on Silicon Valley Bank, but that's what I was trying to say in a roundabout way, that there are many banks with very similar features. All of them face run or threat of a run because they have large uninsured deposits and their assets are depressed. There is nothing about liquidity when your assets are depressed for a year or a year and a half. It's a solvency issue. We can call it liquidity, but that's my point.
I agree.
I wanted to
Tom?
just answer the question directly about what the FDIC could have done. So we do have this capability of paying out a large percentage of uninsured deposits, even though the bank has failed. So in the case of Silicon Valley Bank, for example, the FDIC knew that it could have paid out 90% of uninsured deposits with the bank failing. And so the notion that somehow it was needed, as Secretary Yellen said, to bail out the bank so that they could pay out 100 cents on the dollar was just completely fallacious. And it really showed how political this bailout was. So the answer to your question is yes, it could have been solved a different way.
Thank you all very much. Thanks to the panel for all their work. Thank you.